Bob Parker joins us now, Senior Advisor at Credit Suisse. You've been here, Bob, for almost 20 years. Previously worked for Lloyds Bank and Rothschild. Man and boy, perhaps. Interesting what we were hearing from Mr. Blanchflower earlier. He was saying that a European bomb could go off at any time, throwing everything into disarray once again.
Well, let's define the word bomb.
OK.
Because there are a whole series of, I would say, pockets of problems. The first issue, which frankly needs to be addressed this month, and you had a statement from the European Union yesterday that they hope to get an agreement on Greek debt by the end of June. And that agreement is probably going to be additional funds from the EU and the IMF for 2012, because clearly at the moment Greece can't come back to public markets in 2012, and that was the original plan. That plan obviously now has to be revised.
But before that happens, I mean, we need to make sure that they even get the second tranche, and that will be announced, we're expecting today. So there's something much more immediate that may actually shake up the markets.
I'm working on the assumption that the probability of them not getting the tranche of IMF and EU funds this week is very low indeed, because, you know, clearly if they don't get it, then how is Greek debt going to be repaid? And the answer is it's not going to be repaid. So, you know, it comes back to, you know, Danny Blanchflower's comment about a European bomb, and that certainly would be a bomb.
Yeah, it would indeed. The so-called Vienna initiative, it certainly seems to be gaining traction within Europe, so that banks maintain their exposure on a voluntary basis. Is that a real goer for you? Is that a winner?
If you look at who owns Greek bonds, clearly the biggest exposure actually is now shifting to the public sector being the European Central Bank and national central banks in the Eurozone network. In the private sector, the exposure to Greek bonds is concentrated in the Greek banks, the German banks and the French banks. Clearly those banks, which are in the process of increasing their Tier 1 capital under Basel III, and they have to do that, there's no alternative, they can't afford to take a write-down today on Greek or other European exposure.
Not today, but when?
Well, ideally, you know, and this gets into the debate about will there be a write-down eventually on Greek debt, and I think inevitably there has to be, because if one looks at the mathematics of revenue generation in the Greek economy and their debt profile, clearly the numbers are unsustainable. Now, I think the orderly process would be a write-down over a period of years.
But we're talking about, it seems like the German government is trying to push for some kind of orderly restructuring in 2013. Now,
Correct.
2013 seems really, pardon me, you know, like 2 decades away from now, because every day, even now, as we were just saying, we have issues about whether they'll get the second tranche, about whether they'll get more money at the end of June. How can we hold off until 2013?
I think the only way that you can hold off for a Greek debt restructuring prior to 2013 is an increase in the IMF and the EU/ECB facility. The loan package to Greece, currently at 110 billion, that could well be extended to in excess of 160 billion to cover their debt repayments, at least in the first half of 2012. There's no alternative.
Now, we're consumed somewhat by the European debt crisis. There is something of another crisis going on across the pond, the US debt ceiling. Republicans failed the debt limit, raising that, failed to win House approval yesterday. How much of a worry is that?
Well, I think there are a number of issues here. The first issue is obviously what happens if the debt ceiling is not extended, and the answer to that is that the US Treasury will stop paying its bills primarily.
They've got about 8 weeks, haven't they, with a little bit of...
Well, we're talking the first week of August, and, you know, if that debt ceiling is not extended, then a raft of public sector workers in the United States will be paid in IOUs, not in cash. That's the first stage. I think the more fundamental issue is, are we going to get this continuing political gridlock between the Democrats and the Republicans on dealing with the budget deficit, which, let's not forget, on an annualized basis for the last 3 months is running in excess of $1.7 trillion, 9% of GDP. And that, obviously, if that is not dealt with, and I suspect there will only be minor measures to deal with it, then that obviously bodes negatively for US Treasury Treasury yields and the US dollar.
Bob, talk to me about, in this difficult situation in Europe but also in the US, what does it mean for how you would be playing the markets right now? Are we going to see a little bit of a correction in a lot of these markets in the next couple of weeks, or if we do get an agreement on the European debt crisis, does it mean that we'll get an upswing?
Well, my central case is that we will get an agreement on the European debt crisis. Having said that, there are a number of other problems in Europe which we need to be aware of. The write-down on Irish bank debt, problems in the Spanish regional governments, which the markets are not focusing on at all, and that could be an issue.
Against a background of slower growth right across the world?
Well, we've had very clearly over the last 3 months a slowdown in the global economy, and I would argue that accounts for the poor performance of equities last month in May and the low G3 government bond yields. I think you're going to be surprised as we go into August and September that the global economy actually starts to pick up again. That's positive for equities, negative for G3 government bond yields.